you were president of the Federal Reserve Bank of St. Louis for 10 years. I happen to agree with Dr. Paul's thesis here, and many economists, including the Economist magazine, laid out the case that the Federal Reserve from 02 to 06 had set a negative real interest rate in the United States. And as a consequence of that, we were going to create a boom-bust cycle in housing because we were flooding the housing market with credit. That was a mistake of the Fed. That was one of our errors. But the second error, I think, was the government guarantee implied that we had over with Fannie and Freddie, and a situation in which Congress intervened in the market in a very big way in 1992 with the GSE Act, in which we allowed them to go into arbitrage, we allowed them to over-leverage 100 to 1, run up a mortgage portfolio of $1.7 trillion, a lot of it junk countrywide. And a lot of this was under a mandate from Congress because we were muscling. Congress here was muscling the market. The market wanted 20% down. We got that down to 3% and then down to 0%. So what did we think was going to happen? Economists at the time, I remember John Taylor here. Professor Taylor had a solution to both problems. He wanted the Taylor rule, first of all, applied so that we would have a stable monetary policy. We wouldn't have the boom bust that would come about as a result of a flood of credit because we'd keep the monetary unit stable. We wouldn't have a negative real interest rate. And at the same time, he and others, Dr. Poole, yourself included, I think, warned about some of the consequences with respect to this government guarantee. We do not have a higher home ownership rate in the United States than other developed nations. What we had instead was a higher profit to the shareholders of Fannie and Freddie. Study after study showed they were the beneficiary, and management was the beneficiary. So you had managed earnings, you had all the problems we went through. Okay, going forward, what you argued for today was we slowly bring the private market back in as we reduce the conforming loan limits, as I understand basically your argument there, and we phase out. Now, this is the thing I want to ask you. Others are saying, well, you know, yes, we had that problem with a government guarantee with Fannie and Freddie, but now why don't we bring back a government guarantee? Do you think that brings back the same problems with regard to moral hazard, the same problems with regard to risk pricing that we had with Fannie and Freddie if we bring in a government guarantee? Yes or no, Dr. Poole?
I would not have government guarantees for mortgages at all. We don't have government guarantees for auto loans, for all sorts of loans in the marketplace. Why do we need government guarantees for mortgages? It doesn't make any sense to me.